Consider this problem. Lauren buys 100 shares of stock XYZ at $40. She places a stop loss order at $36. She expects that the stock will move to $60 over the next few weeks, at which point she plans to close her position. Calculate Lauren's risk-reward ratio. So first, let's talk about what is the risk-reward ratio. So what does it mean to have a system where the risk-reward ratio is 1 to 2? That means that you're risking $1 to potentially make $2. Or you could say that you're risking $100 to potentially make $200. Or you're risking $1,000 to potentially make $2,000. So that's what it means to have a risk-reward ratio of 1 to 2. It's how much money you're willing to risk to potentially make a certain amount of reward. So let's calculate the risk-reward in this particular problem. So right now she's buying 100 shares at $4,000. So her account balance will decrease by $4,000. Now she has a stop loss order at $36. So in the event that the stock moves against her, once it reaches 36 or below, it's going to trigger, ideally selling her shares at $36. So if she were to sell at that price, her account will be credited with $3,600. Therefore, she's risking $400 in this trade. So that's how much she can lose if the stock moves against her. So that's the risk of this particular trade. Now let's calculate her potential reward. She still put in $4,000, but if the stock moves in her favor and it reaches $60, at which point she plans to sell, she's going to receive $60 times 100, or $6,000. So she is looking at a net gain or reward of $2,000. So that's the reward in this particular trade. So she's risking $400 to make $2,000. Now, we want the risk to be 1, and we want to calculate the reward when the risk is 1. So what we're going to do is we're going to divide both numbers by 400. 2,000 divided by 400, if you cancel the 2 zeros, it becomes 20 divided by 4, which is 5. So in this problem, her risk-reward ratio is 1 to 5. So for every $1 that she risks, she can potentially make $5. But in this example, she's risking $400 to potentially make $2,000. Now, another quick and simple way to calculate the risk-reward ratio in this particular problem is to analyze the problem looking at just one single share of stock. So she's buying the stock at $40, and at worst she's going to sell it at $36. So the most she can lose if the stock moves against her is $4 per share. So that would be the amount of money that she's risking per share. Now the most that she can gain per share, if she buys it at 40 and sells it at 60, that's a gain of 20. So her reward is 20. Dividing both numbers by 4, you can also get a risk-reward ratio of 1 to 5 if you look at it at a per share basis. So those are two ways in which you can calculate Lauren's risk-reward ratio. Number 2, Tegan is analyzing a trading system which has a win rate of 15% with an average risk-reward ratio of 1 to 4. Calculate the amount that she expects to earn on average if she risks $1,000 for a single trade. So what we need to do is calculate the expectancy of the trading system. To calculate expectancy, you could use this formula. It's x1p1 plus x2p2. x1 can represent the amount that she will win and P1 can represent the probability of winning. X2 could be the amount that she loses, where P2 would be the probability of losing. So with reference to this problem, we could say that X1 is the reward, that's the amount that she'll win. P1 is the probability of winning. X2 is the amount that she stands to lose, so we could say that's the risk. P2 is the probability of losing. So let's talk about the risk-reward ratio of this problem. So the risk-reward ratio is 1 to 4. And we know that she's risking $1,000 per single trade. So if the risk-reward ratio is 1 to 4 and she's risking $1,000, what is her potential reward? Well, it's going to be 1,000 times 4, or 4,000. So if she calls it right and she wins on this trade, she can earn $4,000. And the probability of winning, that's the win rate of 15%, which is 0.15 as a decimal. Divide 15 by 100. Now the amount that she stands to lose is what she's risking. So we're going to put a negative sign there. So that's a negative 1,000 times the probability of losing. If there's a 15% chance that she's going to win, there's an 85% chance that she's going to lose, or 0.85. So you can find that number by taking 1 and subtracting by 0.15. The maximum probability is 100%. So 100 minus 15% gives you an 85% chance of losing. So now let's do the math. So 4,000 times 0.15, that is 600. And then 1,000, or negative 1,000 times 0.85, that is negative 850. So the expectancy of this trading system is negative $250. So what does that mean? So this means that she expects to lose $250 for every $1,000 that she risks per trade on average. So as a decimal, if you divide 250 by 1,000, you'll find that her expectancy is 25 cents for every $1 that she risks per trade. So if she were to risk 10,000 per trade, her expectancy would be, she would expect to lose $2,500 per trade on average for risking 10,000. So she's losing 25% of whatever she risks per trade. So that's how we can calculate the expectancy of the trading system in part A. Now let's move on to part B. Calculate the expectancy of the trading system that has a win rate of 40% and a risk-reward ratio of 1 to 2. So in this example, we don't know the amount that she's risking. So her reward is 2. The probability of winning is 40%, or 0.40. The amount that she's risking is 1, so we'll put negative 1. And the probability of losing is going to be 60%, or 0.60. So 100% minus 40% is 60%. So that's what you can do for part B if the risk-reward ratio is 1 or 2. She's risking $1 to make $2. So 2 times 0.40 is 0.80 minus 0.60. So the expectancy of this trade is 20 cents for every $1 that she risks per trade. So now, is this a good trading system or is this a bad trading system? What would you say? Well, notice that the answer is positive. That means that she's making money per trade. This is a good trading system. In the last trading system for part A, she was risking, well, her expectancy was negative 25 cents for every dollar at risk. So because the expectancy was negative, that's a bad trading system, because if she keeps using that trading system, she's going to lose money over time. But this one, it's the answer is positive, which means that she'll make money over time if she uses this trading system. So if she were to risk $1,000 per trade, she would expect to earn $200 for every $1,000 that she risks per trade, which is pretty good. So in the long run, she's going to earn income with this trading system. So that's how you can analyze the expectancy of a trading system to see if it's good or bad, is by knowing the risk reward ratio and the probability of winning using that trade system over the long run. Now let's move on to part C. How much will Tegan expect to gain or lose in part B if she risks $10,000 per trade? To get this answer, you multiply 0.20 by 1,000. So to find the answer if she risks $10,000 per trade, you would multiply 0.20 by 10,000. So the answer would be, her expectancy will be that she will make $2,000 per every 10,000 that she risks per trade. So that's the answer to part C. It's 2,000. The answer for part B is it's 20 cents per dollar at risk. So now you know how to calculate the expectancy of a trading system and the amount that you can expect to win per trade given the amount that you're risking per trade. Let's work on one more problem. Calculate the minimum win rate needed for a trading system to break even given a risk-reward ratio of 1 to 4. So how can we calculate the win rate given the risk-reward ratio? So first, let's start with the expectancy formula. We know that the expectancy of our trading system is going to be the reward times, well, let's write the reward as RW. So it's going to be the reward times the probability of winning plus the risk, which we'll write it as R sub K, times the probability of losing. Now, in order to break even, the expectancy must be 0. Now, we could put a negative sign for RK because it's a negative value. Now, I'm going to move this to the other side. So we have RK times PL is equal to RW times PW. Now, what I'm going to do is I'm going to replace the probability of losing with 1 minus the probability of winning. Because if there's a 40% chance of winning, there's a 60% chance of losing. 1 minus 0.4 is 0.6. So PL is 1 minus PW. Next, we need to distribute RK to 1 and to negative PW. So RK times 1 is just RK, and then we have minus RK times PW. Now I'm going to take this term, move it to the other side. It's negative on the left side, but it's going to be positive on the right side. So we're going to have plus RK PW. Next, we're going to factor out PW. So we have RK is equal to PW, and then we're left with RW plus RK. Now we're going to divide both sides by RW plus RK. So thus we have the probability of winning, which is the only thing on this side of the equation, and that's equal to what we see on the left. That equals the risk, RK, divided by RK plus RW. That is the risk plus the reward. And to convert it to a percentage, we're going to multiply this by 100%. So that's the formula that we could use to calculate the probability of winning given a risk-reward ratio. So let's make a table. And on the right, we're going to put the win rate. So in this example, we have a risk-reward ratio of 1 to 4. So the risk is 1, the reward is 4. So it's basically 1 over 5 times 100%. 1 over 5 is 0.20, and 0.20 times 100% is 20%. So what does that mean? If the risk-reward ratio of your trading system is 1 to 4, in order to break even, you need a win rate of 20%. In order for that trading system to become profitable, you need a win rate of something greater than 20%. So if your win rate is 25% with a risk-reward ratio of 1 to 4, that means you have a good trading system. Now let's look at some other numbers. What if the risk-reward ratio is 1 to 3? So then the probability of winning is going to be the risk divided by the sum of these two numbers, the risk plus the reward times 100%. So that's 1 over 4 times 100%. 1 over 4 is 0.25. So for a 1 to 3 risk-reward ratio, you need a 25% win rate in order to break even. Now what about a 1 to 2 risk-reward ratio? So all you got to do is take 1 divided by 1 plus 2. So it's 1 over 3 times 100%. So the the win rate needs to be 33%, 33.3% to break even. So if you want the trading system to be profitable, given a risk-reward ratio of 1 to 2, you need a win rate of something greater than 33%. So 34% would make the trading system profitable, or 33.4%. Anything above 33.3% will make it profitable. Now what if the risk-reward ratio is 1 to 1? In this case, it will be 1 over 1 plus 1, which is 2, times 100%. So for a risk-reward ratio of 1 to 1, you need a win rate of 50% to break even. Now let's say if we're risking more than the potential reward. Let's say if we're risking $200 to potentially make $100. What's the win rate that we need to break even? In this case, the risk is 2 divided by the sum of the risk and reward, which is 3, times 100%. So it's going to be 2 out of 3, which is 0.667. So you need a win rate of 66.7% to break even. If the risk reward ratio is 3 to 1, this is going to be 3 over 3 plus 1, or 3 over 4. So then the win rate has to be 75%. And let's do one more. So if we have a 4 to 1 risk reward ratio, it's going to be 4 over 5, or 80%. So looking at the information on the right, what do we learn from the data in that table? Well, this tells us that a trading system that offers a high reward relative to the amount that's placed at risk, that trading system requires a relatively low win rate in order for you to break even. Whereas a trading system that offers a small reward for a large amount that's placed at risk, that trading system requires a relatively high win rate in order for you to break even. A good example of the first scenario is buying options. Let's say if you were to buy a call option and the stock were to move, a lot toward the upside. The potential reward is huge, but the probability of that trade being successful is low. And so that's a good example that illustrates the first situation. Buying options offers a high reward, but the probability of winning is relatively low. This situation can be described by selling options. The probability of winning when you sell an option is high because you're getting paid to sell the option no matter what the stock does, whether it goes up or down or if it goes sideways. Nevertheless, when you sell options, you typically place a lot of money at risk. And so your reward is small, but your risk is huge. And even though the probability of winning is high. So this situation can be described by selling options, whereas this one would relate to buying options. This example problem listed on the board will illustrate the risk-reward ratio of buying options versus selling them. Number 4, stock XYZ is currently trading at $40. Jared buys a 30-day call option with a strike price of $40 for a cost of $3. The stock moves to 55 by expiration. Calculate Jared's risk-reward ratio for this particular trade. Now keep in mind, a call option gives the owner the right to buy stock at a certain price, that is the strike price. So anytime during this 30-day period, while this call option is active, Jared can exercise his right to buy the stock at $40. And one call option controls 100 shares. Now the price that he paid for this call option is $3. So it's $3 times 100 shares. So he paid $300 for the call option. Thus, that is the most that he can lose on his trade. So that is the risk. Now what about his potential reward? So what happens if the stock moves to 55 by expiration? At expiration, the value of the call option will be the difference between the stock price and the strike price, because he can go and exercise the call option, buy 100 shares at 40, and then sell it for 55 at the market. Thus, he'll experience a gain of $15 per share. So the value of the call option will be worth $15. So $15 times 100 means that he can sell the call option for $1,500. That is the reward. So now let's calculate the ratio. So he's risking 300 to make 1,500. If we divide both numbers by 300, we get a risk-reward ratio of 1 to 5. So as you can see, buy and call options give you a huge potential reward relative to the amount that you're risking. He's risking $300 to make $1,500, or equivalently, for every $100 that he risks, he can potentially make $500 for a trade like this. Now, the win rate that he needs in order for him to break even using this method is going to be 1 out of 1 plus 5, or 1 out of 6 times 100%. So he needs to win 16.7%. His win rate needs to be 16.7% in order for him to break even using this trading system. If he can achieve a win rate of 25%, then this trading system for him will be profitable. If the win rate is less than 16.7%, then he's going to lose money over the long run. And it makes sense why buying call options have a low probability of success, because the only way you'll win is if the stock moves in the right direction and in the right time frame, because this option will expire in 30 days. If the stock moves sideways, Jared loses. If it goes down, he also loses. Now, he could lose if it goes up too slowly. If it goes up but doesn't go up fast enough in the 30-day time period, he can still lose. The only way he's going to win is if he's right about the direction and also about the timing. Thus, the probability of being successful when buying options is relatively low. But nevertheless, there is a high potential reward to offset the low win rate. Now, let's consider the other scenario, that is selling options. Part B. Julia sells a 30-day cash secured put option on the same on the same stock with a strike price of $40 for a premium of $4. Calculate Julia's risk-reward ratio for this trade if the stock moves to 55. Now, a put option gives the owner the right to sell their stock at a certain price, in this case at 40. So whoever buys the put option from Julia will have the right to sell 100 shares to Julia at $40, which means Julia is under obligation to buy the stock at 40 if the person who bought the stock exercises that right. Typically, they'll exercise the right to sell their shares at $40 if the stock price moves below 40. So if it moves at 55, they're not going to want to sell their shares at 40 when they could sell it in the market for $55. So thus the value of put options increases when the value of the stock decreases. So for Julia, if the stock moves up, that's good. If it moves down, that's bad. So Julia can win if the stock moves up or if it moves sideways. If the stock falls below $40, she's looking at a potential loss. Her break-even point is 40 minus 4 or $36. So if it were to fall to $37, she would be okay. She would have a net profit of $1 per stock. But if it were to go below $36, let's say like $33, now she's at a loss. But notice that her chances of winning is greater than Jared, because if the stock goes up, she wins. If it goes sideways, she wins. If it goes down a little, she wins. If it goes down a lot, she loses. So the probability of winning when selling options is higher. However, her reward is not that high. And so in both cases, there's a trade-off. Either you have a trading system with a high reward but a low win rate, or another trading system with a low reward and a high win rate. So now let's calculate her risk-reward ratio. So how much is at risk? Julia is under obligation to potentially buy stock at $40, and keep in mind every option controls 100 shares. So she's at risk of buying 100 shares at $40. Thus, the most that she can lose is the value of those shares, 40 times 100. So she has $4,000 at risk. Her reward is the collection of a premium of $4. So 4 times 100, her reward is $400. So if we divide both numbers by the smaller of the two, that is by 400, 4,000 divided by 400 is 10. So her risk-reward ratio is 10 to 1. So in order for her to break even, it's going to be 10 over 10 plus 1, or 11, times 100%. So the minimum win rate that she needs in order to break even is 90.9%. So she needs to be at least right 9 out of 10 times in order for this trading system to be successful. So that's an example of selling options. You're risking a lot to make a little, but there's a very high chance that you'll win, which means you need to make many trades over time in order for this to be profitable, because the reward is usually pretty small. So hopefully that helped you to understand the concept of the risk-reward ratio and how it applies to options. So now you know how to calculate the risk-reward ratio, you know how to calculate the minimum win rate in order for a trading system to be profitable, and you also know how to calculate the expectancy of a trading system if you know the win rate and the risk-reward ratio. So that's it for this video. Hopefully you found this to be educational, and thanks for watching.